Welcome back, folks. Well, for the market, as of now, the Nifty is still down 157 odd points. The Bank Nifty is down almost 580 points and not looking good at the moment. But let's talk about the gold financing space now. Lenders like Muthoot and Manappuram Finance have seen their customer base decline over the last few quarters as customers are shifting from NBFCs to banks. To get a closer look at what's playing out and what is being done to gain customers in gold financing, we are joined by VP Nandakumar, the MD and CEO of Manappuram Finance. Mr. Nandakumar, thanks a lot for joining us. You know, this is the big debate, right? Customers are now shifting from NBFCs to banks for whatever reasons. And that perhaps is the reason why your industry is seeing the customer base decline. What do you see as the long-term sustainable solution to that?
See, I don't see the customers are moving from NBFCs to banks. Rather, what is happening is NBFC customers, mostly from the lower end of the pyramid, their demand has come down because of the post-COVID. Post-demand, their demand was started picking up by the time they were hit by the COVID pandemic and prolonged lockdowns. This has really impacted their cash flows, their businesses, etc. There, the demand has come down. It is not because of the shift from NBFC to banks. It is not like that.
Mr. Nandakumar, actually, the factors that you're describing, demand should have gone up, right? Not down for credit. Because these are all events which caused a fair bit of pain overall to the segments of population you're describing. Gold loans are one of the quickest and easiest ways to get credit.
So I think it is a mistaken understanding. You see, the demand comes mainly from because of their activities are going well. They need cash, working capital, etc. Then only the real demand from these sections. What I mean is those engaged in cottage industries, those engaged in farming and allied activities. See, not only in gold loan, if you take the example of two-wheelers or this used car, particularly in the lower segment, the demand has come down. So that segment is what our gold loan segment is. So see, the large ticket borrowers who wanted to borrow for a longer time, yeah, they have been historically the bank customers, whereas the lower end of the pyramid where the ticket size is below 1 lakh and borrow for an average period of, let's say 3-4 months. They were typically the customers of an organized sector, and they are now our customers. So that segment is yet to pick up. It is started slowly picking up, but it has not come to that pre-COVID level. It is still lagging. We hope things will improve in the coming 2-3 months.
Mr. Nandakumar, good morning. So at the end of the day, your gold AUM growth has been quite weak. So if you could give a guidance on that, and to sort of get the customers back, what are you doing? Is teaser rate going to be back in action perhaps?
See, it is. Their overall demand depends upon the economic activities in that particular segment. There we see the sluggishness in across all the segments. So it is where it has come down. And see, when the economy picks up and the activities there also increasing, etc., it will come up because these people mostly borrow for in the farming season, like sowing season, or school reopening season, or functions at home, marriages and other functions, etc. These are gradually picking up, and the demand also we see gradually increasing.
So, your customer base, just to get it down, drill it down to specific numbers, right? By the end of FY22, your customer base had gone down to about 24 lakhs. You used to enjoy 26, 27 lakhs as well in the last few years. Just want to understand whether there will be a further fall in terms of absolute numbers, and is there anything that you're doing to gain customers in gold financing?
See, as I told, yes, it is because the demand was down. It is slowly improving. So our ticket size is average ticket size is around below around 50,000 rupees, and the average borrowing period is around 6 months. So these customers, for the last one or two cycles, they didn't need money. They didn't come, and when these activities restart, they are bound to come. And because of the activities, we see slowly improving. I hope, from here it will pick up and come back to the old level, and further from there it will go up.
Right, Mr. Nandakumar, could you tell us what will gold loan growth for you look like in percentage terms? And will you rely on new customers coming in, or sort of existing customers? What is churn, etc., going to look like?
See, usually 80% of our customers used to be repeat customers. Some 15 to 20% used to be new customers. New customer acquisition is happening regularly. Only from the existing customers, there is some sluggishness in demand. So what I look forward is in 1 or 2 quarters, the numbers will come back. Both growth will come back. So there is no decline in portfolio. Yes, it is seen as flattish, and we have seen some decline in the past. It has come to a flattish stage, and here onwards, we feel like it will slowly grow. This year itself, we expect from that stage to a growth of around 5 to 10% this year. Next year, our usual growth of 10 to 15% will be achieved. This is our expectation.
To 15% gold loan growth?
That is in the next year, and this year I expect that to grow by around 5 to 10%.
5 to 10 this year and 10 to 15 next year, FY24.
Yeah, this used to be our normal growth in a normal period.
Sure. Should we, are you lending more to existing customers using new collateral? Should one be a little wary about that? I mean, not just you, but the industry. Because of, stress or whatever?
No, it is evident from the fact that the demand, the average ticket size has not gone up.
Okay.
Average ticket size remains the same. It is not because of that.
Okay. Also wanted to ask you about the MFI book. There is quite a bit of pain over there, but going forward, what is the outlook?
Yeah, our book is relatively better, it appears, because from the SFO, the SRO data, what we understand is the industry, the NPA is higher, PAR is higher, and ours is seen lower than that.
Okay, all right. Ms. Nandakumar, we leave it at that. Thanks a lot for joining us. That's Manappuram Finance. The big problem really for them is that customers have been moving from NBFCs to banks. So the customer base itself has been shrinking for many of these companies.
The other point he made is interesting. So because of all this stress, he says the demand does not come because of demand comes, of course, when there is growth, and growth has been lacking. I mean, business activity or whatever has been lacking, and that has been the real problem. Existing customers really not too excited to borrow more. A new customer addition, of course, has been poor. 5 to 10% gold loan growth this year, and after that, back to the trend of 10 to 15% growth in FY24. Let's move on. TeamLease has seen a very weak set of first quarter earnings. There has been margin decline across segments, with consolidated figures seeing a 90 basis point slip. To discuss the outlook and hiring trends, we are now joined by Ramani Dati, CFO at the company. You'll have to pick it up. Sorry.
All right, Ramani, thanks a lot for joining in. This is Sonia here. I just wanted to talk a little bit about your earnings, because I think we didn't speak about it post your numbers coming out. Your margins across segments have declined quite a bit, and you're already sitting with low single-digit margins, right? In Q1 of FY23, your consolidated margins were just 1.3%. So just trying to understand, by the end of the year, what kind of margin trajectory are you looking at, and why is it that you're seeing so much pressure?
Thank you, Sonia. So firstly, in terms of top line growth, we are seeing very good demand. Even this quarter, we have added 13,000 headcount in our general staffing business, and we crossed 2 lakh overall headcount in our staffing business. So what exactly has impacted our margins in this quarter particularly are three reasons. So one is the inflation in our associates. Typically, we used to have 5 to 6% salary inflation in the associates that we have in our general staffing business. Last year, it was almost 11 to 12%. So with the gross salaries going up, that has put on a pressure in terms of our percentage margins. While the absolute margins are improving in our staffing business, as a percentage, this increase in top line is putting pressure. That's one reason. Second one is specific to this quarter. So there is a higher hikes given to our core employees as well. Again, historically, we have been giving about 7 to 8% hikes to our own core employees. And this year, matching the market demand and the corrections that are required to be made, we also have ended up giving 12% hikes to our core employees. So that has led to almost a 5-6 crore increase in our costs in this quarter. The third one is there are few one-time impacts, like we have an EdTech business. So typically Q1 with holiday season for almost all universities, no admissions happening. So there is a 5 crore impact straight away coming from our EdTech business. So it's largely an account of the salary inflation, and all the costs are fully absorbed. So we are very positive about the outlook for the upcoming festive season. So with the cost being fully absorbed, we are confident of taking the year-end margins back to last year numbers that we have posted.
Ramani, hi, good morning. Prashant here. So what will it look like? Now you're saying that a lot of the pain is in, you've taken the cost increases that you had to. So could you give us some guidance on what realizations will look like, what margins will look like for the full year?
Yeah. So from Q2 onwards, Anuj, we are consistently, Prashant. So we are looking for a consistent quarter-on-quarter expansion in our margins. We don't give an exact guidance, but we are hopeful of closing the year with the margins what we closed with last year. And this is mainly on account of operating leverage coming from our staffing business, because as I mentioned, the costs are fully absorbed, the growth will straight away contribute to the bottom line, and the contribution from our higher margin businesses like IT staffing, EdTech business. So those are also increasing. So with that, we are confident of taking the margin upwards.
Okay. You, in the conference call, you had said, Ramani, that you're witnessing a tightness in manufacturing sector, layoffs and deferred hiring, but subsequently open positions are increasing and demand seems to be coming back in Q2. Can you explain what exactly happened and what is the takeaway from that from an investor standpoint?
Sure. So in the beginning of the year, we have expected very high demand from manufacturing, infra and engineering industries, maybe with the back of PLI schemes and other initiatives by the government. But unfortunately, we are not seeing that much of demand on the ground within manufacturing and engineering segments. So while there is a little bit of sluggishness there, we are seeing better outlook from other industries like BFSI, retail, telecom, because retail for a long time has continued at very low numbers because of COVID. Now that with all the retails being opening, the physical retail as well as e-commerce being back, so we are seeing very strong outlook and demand there. But at this point in time, manufacturing and industrial still seems to be low.
Okay, all right. So can you give us some guidance in terms of hiring? What are you looking at for this year? And also the general staffing, I think, was around 13,000 between last quarter and this one in Q1. General staffing hires. What is the guidance for the next few quarters?
Yeah. So we are planning to have at least 18 to 20% headcount growth in our general staffing business this year. So this is the minimum number that we are confident. In case if there is a recovery and better numbers by the festive season in Q2 and Q3, we may close with a slightly better numbers as well. So last year we did about 57,000 headcount in our staffing businesses overall. So we should come close to that number this year as well.
Okay. Ramani, we'll leave it at that. Thanks a lot for joining us. That's the CFO of Team Lease Services. By the way, the market, it's not gotten worse. It's still down, but not out, you'd have to say. The Bank Nifty is down almost 530 points. But the good part is that from the morning lows, it's actually come up a little bit, so stabilizing around these levels. We'll slip into a quick break. We'll leave you with some global market opinion. Earlier in the show, we caught up with Lawrence Belanco of CLSA, who says that there is a greater downside risk from a medium-term viewpoint. Listen in.
Unfortunately, we've seen this pretty broad trading range for the Nifty year to date, roughly 15% wide. So we've really traded between 16,000 and 18,000 year to date. And the rally that we've seen off the June lows is now taking us into that resistance zone, which is basically the highs that you made back in March and the highs that you made in January. And in conjunction with that resistance area, we have some of our shorter term indicators flashing buying exhaustion, so that comes from our DMARC indicators. So we do think there's a downside risk for a correction within that range that you've seen year to date. We need to be aware that the upside risk isn't attractive here. And even if we just take it to the midpoint of the range, we have greater downside risk being capped at the 18,300 area. And our view for US markets is that we do think we retest the June lows, which does leave the Nifty vulnerable to fall back to that 16,000 area, which is where we've seen the lows develop in June as well as back in March. So there's definitely a risk of falling back to retest the lows. We think that is a likely event basically going forward. And the best case scenario is actually to find support at the midpoint of this range where the 200-day moving average sits, and that's roughly at the 16,800 area. Base case is that we have a 5 to 8% correction, which puts us roughly back in the middle part of the range.
Well, Mitesh Thakkar is now joining us for some trades once again. Basically, on the market, the Nifty is slightly off the lowest point of the day because of Reliance. Reliance is holding out and ITC is holding out. But the Bank Nifty is the problem point. It was the problem point on Friday as well and today as well. Just look at the Bank. In fact, even Reliance has taken a bit of a tumble. It looked like at least that was holding out. The Bank Nifty is an issue here. Mitesh, morning again. So is this a reversal now, or is this still sort of a largish uptrend in which we are seeing a pause? Your views and your stock calls.
No, my view still remains that this is a largish uptrend in which we are seeing not a pause but maybe a pullback and a correction also, because this up move which started in the last week of June from levels of 15,191 hasn't had any kind of a decent pullback. So I think that process has begun now. The initial understanding is that 17,550, 500, maybe 17,420 should be the area where this pullback can possibly end. But it can go even deeper as well because we have medium-term averages slightly still lower. So in that sense, I think we are not in a hurry to buy into this market and therefore waiting it out. As I said, I think but broadly this remains a market which I think after this pullback plays out will once again restart an uptrend. So that idea has a strong conviction for me. For the time being, I have a buy on HDFC Life. That's a stock which is taking good support around the short-term averages. So that's a buy with a stop below 563 for targets of 590. And Bajaj Auto is another auto name which is kind of giving you a breakdown on the hourly chart. So keep a stop at about levels of 40.65 and a target of around 39.40 on the downside.
Okay, Bajaj Auto is a sell. Mitesh, thanks a lot for that update. Let's now go across to Manisha Gupta for an update on commodities markets. Manisha, morning, tracking crude?
Oh yes, Anuj, and what a decline that we've seen extending during the day as well today. The Asian markets have opened on a weaker side and there have been various reasons for that. I want to talk about the reason that the crude prices have declining, and that is because the Iran and the Western nations are now exempted closer to striking a nuclear deal is what the markets are talking about. Now, right now, it is almost happening is what various media also seems to be reporting, and is the reason you have seen a decline in crude prices. What this will do is that if the deal does go through, then this would lift sanctions on various institutions, 150 Iran economic institutions and nearly 17 Iran banks as well, and that the markets is looking at positive on. Iran would also be able to export nearly 50 million barrels per day in 4 months of signing the nuclear deal is what the street is working with. Right now, the current production from Iran is at 2.5 million barrels per day. The expectation is that once the deal is done, that in 6 months of period, it will go to its maximum capacity of 3.7 million barrels per day as well. Iran and a nuclear deal is one of the reasons that we have seen pressure on crude oil prices. But apart from that, it also has to do with China, where we have seen demand continue to be on the weaker side because of post-COVID-led restrictions there. The US dollar index as well, trading at a 5-week highs above 108, is putting pressure on many of those commodities. I want to put on board on what the crude oil prices have done in last 4 or 5 months in sense of monthly ranges. We have been able to keep above $100 a barrel for all these months there. There have been some instances when we did see prices drop below $100. There have been instances, especially in the month of May, when we saw the prices at $120 a barrel as well. But for the month of August, it has been almost every second day that you have seen prices fall below 100. Last 14-15 days, actually, the prices have been trading below $100 a barrel as well. We've seen a low of $92, and we are trading at around 93 to 95 in the international markets right now as well. Supportive factors, though, also there are plenty for crude. One is, if the Iran nuclear deal does not go through, you will see a rebound come in case of the crude oil prices. The other thing to watch out for is the Atlantic hurricane season. There are 5 to 6 named hurricanes and 20 named storms as well, which could be happening between September to October. So any damage to Gulf of Mexico will keep the prices higher. And then the European Union sanctions on Russia oil from December 5 is something that is keeping the markets jittery. And above all, it is going to be OPEC and allies. That meeting is happening on 5th of September with expectation that if the prices continue to decline, you could be looking at a cut in output is what the OPEC Secretary General already has said. That could be supportive for prices as well. So good support is what we are seeing in case of crude oil prices right now, but that's not what the markets are anticipating for the month of September, October. Too many uncertainties lined out there.
Okay, thanks a lot for that, Manisha. Well, let's go across to Rima now. She's tracking Adani Ports this morning. Rima, why is that?
Well, I'm actually tracking Adani Power because they've agreed to acquire DB Power Limited for an enterprise value of more than 7,000 crore rupees. DB Power operates and runs a 2 into 600 megawatts thermal power plant in the Champa district at Chhattisgarh. And the acquired company DB Power had an annual revenue of 3,500 crore nearly in FY22. Now, the reason for Adani Power to acquire DB Corp's thermal assets is it will help Adani Power expand its offerings and operations in the thermal power sector in the state of Chhattisgarh. Back to you.
Okay, thanks a lot for that. And Shilpa Medicare is the other one we're looking at. Ekta is here with more on that. Ekta.
Thanks for that. The company's completed phase 3 human clinical trials of the first biosimilar under their belt, which is adalimumab. They have submitted the dossier to the CDSCO, which is basically the Indian drug regulator, to review it for marketing and
get a rating, and the rating should be different for the two debentures, the senior and the junior. Would that be the solution?
So Lata, extending what Srini is saying, I think the kind of solution required is that we get a realistic valuation of all kinds of instruments, whether they are loans, whether they are restructured loans, or whether they are securitized SRs, which have been bought back by the investor. And the reality is the ecosystem today relies a lot on prescriptive regulations, which prescribe that for so-and-so type of loan, you shall provide so-and-so kind of provisions, without taking into account what the business assessment of the recoverability of a loan is. There is a level of subterfuge involved in not being truthful about what the possible loss on an exposure could be. I think that's where the regulatory discomfort comes. And every time you undertake a structure which does not come clean in terms of valuations and disclosures, I think the possibility that we are building up a set of risks in the ecosystem, as we did 10 years ago, by doing restructuring S4As and 525s, etc., and kicking the can down the road until it became too big to kind of manage, that possibility remains. I think that entire ecosystem of valuing risks appropriately should be relooked at. By the way, businesses know what those risks are. To say that we don't know because valuation is a gray area is rubbish. Businesses know what the best case recovery is, what the worst case is, what the most optimistic case is. Starting from there and then on to the valuation agencies, on to the boards, there should be an onus on them to ensure valuation and disclosure is appropriate.
Yeah. Srini, out of time, but just a final question. It doesn't look like SEBI or RBI would want to kill the structure, but if they start putting in some kind of conditions in terms of the senior partner, which is the PE, has to take the first loss guarantee or something, you think the structure itself will collapse?
I don't think so. Look, you see, first loss guarantee may be one of the options, but the reality is that the industry is already engaged in trying to provide the right framework, including checks and balances in very many forms, to make sure that the regulators are comfortable with what we are doing. Most importantly, as Anand mentioned, it's not very different from the security receipt structure, where there is significant upfront cash that is actually paid by the AIF to the NBFC in case there is an NBFC on the other side. Okay. And the other aspect of it is that, I don't think the regulator today is likely to collapse the structure because it provides a very significant opportunity for the deepening of the lesser heralded bonds in the market. So I think we will have the right checks and balances, and we will make sure that the regulators are comfortable with whatever the checks and balances that they believe ought to be the case, and including whatever provisioning norms or disclosure norms that may be prescribed by, let's say, RBI, for example.
Okay. Well, I guess the two regulators could be talking, and we would hear what their desire in terms of a solution is, probably rating of the two separately, or the PE investor giving a first loss guarantee could be solutions. We don't know. But it's important that the regulators are aware of it. And I think the bigger positive is that perhaps the real estate sector itself is in an upcycle, and we may not be landed with too many unfortunate loans or, bad loans because of this product. Umesh Shivankar, Srini Srinivasan, Anant Narayan, thank you very much for joining me. We wrap up on Bazaar on the note that the markets are still under a bit of pain, perhaps at the lowest point of the morning. Chartbusters takes the action forward.